Hello, everybody, and welcome to Masters of Real Estate. My name is Matthew Owens, a California licensed CPA and full-time real estate investor. And today, I'm going to talk to you about a few asset classes that I think you should add to your portfolio. We invest in mobile homes, in single-family homes, and know how to be the bank and invest in promissory notes and mortgages. All three of these strategies have some great attributes, some pros and some cons that you should be aware of, but they're great recession resistant assets to add to your real estate portfolio that can help you sustain a long-term cash flow throughout any type of recession, as long as you do the math right and you're conservative on your debt financing projections. Okay, so let's talk a little bit about some of the pros and cons here and some of the ways that I think these types of assets can add some great value to your portfolio. So the first thing is in mobile homes, right? Mobile homes traditionally are not actually sought after by the cities. They're not allowing any more of these, so there's a finite supply of mobile homes, and they are the cheapest type of housing that you can get. And so a lot of times they can be very recession resistant because you have multifamily tenants that can't afford those rents anymore if there's a downward spiral in the economy in one way, shape, or form. And so they move down into the mobile home park asset, and so there's upward pressure on rents during a recession for a mobile home type investment. So great recession resistant type strategy there because you have a consistent pressure on those rents to rise. And typically you get a little bit higher cash flow in mobile home parks than you do in multifamilies or some other asset classes that you can invest in, right? So, and I found that there's more upside potential in mobile homes than there are in some of the other asset classes like multifamily. And for example, you can add more units to a mobile home, increase rents, do utility recapture programs and things like that, all to add value and build your equity position that can obviously help you with downside risk protection as well by having plenty of equity in your assets to rely on, okay? But more importantly, having great cash flow so that no matter what happens with values, you're able to create a cash flow stream that you can rely on, right? So definitely increasing the value is a very big positive attribute to mobile homes and the ability to do that. Now there's massive tax benefits you can do too. If you can do a cost segregation study on one of these and front load the tax benefits into year one, you can get big tax benefits in year one on these investments, okay? And you can invest passively as well. You don't have to be the active operator. You can invest with other people that have the skill sets in place that already know what they're doing, qualify for the financing, do all the work, and you can invest and take advantage of these things passively as well. So great attributes to mobile home parks, okay? And there's obviously long-term appreciation, long-term rent inflation over time. Now those two items could go down in the short run, right? But the way the government prints money, you're always going to have long-term inflation if you give it enough time, okay? So, these are some of the positive attributes, but some of the negative attributes are that you're usually in these for a longer period of time, right? So you're usually going to go through and invest for, a 5, 7, 10 plus year period of time, and it might take a little bit of time to do your value add strategy to increase those rents, to increase the efficiencies, add the units to the property and things like that. So it could be a long period of time. You might not have very much liquidity. It might be stuck in that deal for a period of time as well. And usually the other downside that I don't like is that it comes with a little bit shorter term debt. Maybe it's 5-year or 7-year debt on a mobile home park comparative to a single family home that you might get 30-year fixed rate financing on for a single family home. So a lot more stability there than in any most commercial assets, right? This is attributable to multifamilies, self-storage, mobile homes, all different, office spaces. They have typical terms like this that you can see. You can still get 10-year Fannie Mae, Freddie Mac financing on these things as well. Just depends if it qualifies and if it makes sense for your specific project, of course. So let's let's talk a little bit about single family homes. Like, I've flipped over 1,000 single family homes. I own hundreds of rentals on single family homes. So I understand the pros and the cons to investing in single family homes. So one of the biggest things that I think people really like is that they have direct control over that asset. Sometimes they don't like investing in outside syndications where they don't have the control and they're relying on an outside operator to do the work. At the same time, in a single family home, you can actually invest directly or indirectly and invest passively in single family funds as well. So there's some ability to, actually have direct control of these assets if you're not comfortable with relying on a professional operator that's done this a ton to do that workload for you. Some people just can't get over that hurdle. It's totally understandable, right? So in addition to that, you can get 30-year fixed rate loans in place on single family homes, which is really an amazing benefit, especially for the long run. Doesn't matter if the rates are higher right now. If your rate is lower than inflation, then you're typically decimating that debt and taking advantage of inflation by decimating that long-term debt. You can typically get higher cash flows in single family homes as well, and then you can add value as well, just like you do on a multifamily or a mobile home park, but you can add value via the renovation and increasing that value to the new after repaired value of that project. Now, you want to be careful of your numbers, make sure that you're in it for the right price, make sure that your renovation costs are accurate if you're going to be doing that value add strategy. A lot of people do it wrong and end up underwater on those types of deals, right? If you don't know the math right and don't have the right teams. Now, there's long-term appreciation and rent growth, very similar to those mobile homes. Some really big tax benefits as well by front-loading tax benefits, just like any mobile homes. Anytime you own a real estate asset directly, you or through an LLC, you're going to get some tax benefits. And if they do those cost segregation studies, that's where the real magic comes in, and you can really kill it and be able to take massive tax deductions against all of your other passive income first, and then roll it forward to future years, or potentially take it against your active income as well from your job or your W-2 job. So, okay. So in addition to that, it can definitely be recession resistant too. And you can, as long as you are not leveraged to the hilt and you're actually making very good cash flow, you can counterbalance a drop in rents, right? You can counterbalance it. It doesn't matter what happens to the market values of these properties if you're able to hold long term from a cash flow perspective. So these are some of the things that I look at when I'm investing. Now, some of the cons for single families, it's hard to scale, right? You're talking about hundreds of single family homes. The management and the workload that goes into that while you're managing projects in different locations is a big one, right? You have a lot of work of managing the managers, different tenants in the property across the board, different systems. Sometimes you have different managers in place. So really hard to manage the managers and do the workload there. In addition to that, it's usually a little bit lower on the cash flow to start. You start getting that rental increase over time. You start getting more equity buildup over time. You start being able to develop more cash flow over a period of time on some of the single family homes, right? Now, the fun one that I really love investing in personally is promissory notes and debt and being the bank. We call it our Be the Bank program. So, and really been doing that and having that program since, I'd say 15 plus years ago when we first started out in real estate. And it's a great for a lot of attributes. One, it can come with a much more stable cash flow than rental income. With rental income, you might have a repair, you might have tenants not pay, you might have a move out. There's a number of reasons why that cash flow may not come in, right? And it may be volatile. You're looking at your averages on those types of assets, right? But in a promissory note, you're usually getting a set payment for a set period of time. And what's great about them, especially if you're dealing with construction loans versus long-term loans, is you get short-term construction debt that you can put in place, usually a 1-year period of time, so you can have some liquidity back when you're actually investing in these promissory notes. You can also leverage promissory notes and pull some of your capital back, or make interest rate arbitrages and make some really great interest rate spreads and some great returns by doing that type of strategy. Now, you need to know how to protect yourself. You need to know how the paperwork works to do that whenever you're raising investor capital, but it's a great strategy to utilize for sure. And what's great is it usually has a little bit higher cash flow stream because you're not getting that upside potential. One of the cons is you're not getting appreciation. You're not getting tax benefits over a long period of time on a promissory note type investment, right? But there's usually less volatility in your monthly payment. It's more reliable. It's a little bit higher cash flow. And you can have a very good loan to value and get some built-in equity projection or equity protection there on your overall investment. So, for example, I usually lend at 65 to 70% of the after repaired market value, and so I have 30 to 35% equity protection in case something happens in the market or something happens with that house, or there's an overage that occurs or something like that happens where I got to pull the actual asset back and own it myself if there's a problem, right? And you can also diversify into multiple notes. So, if you invest in a fund or you have a big cash stack, you can invest into diversified investments there where you have multiple assets across different markets, different borrowers, and really a safe portfolio of assets that you can invest in. And you don't have to have leverage in those types of deals. So it's really all equity in a lot of those types of funds. Some funds leverage, some funds don't, and you need to understand the differences when you're investing in those types of funds. So I hope this helps give you strategies and ideas for 3 asset classes that I think are extremely valuable and recession resistant in comparison to some of the other asset classes and projects out there, right? So mobile homes, single family homes, promissory notes are all great strategies, all have different pros and cons to consider when investing. And so, but they can be a great strategy to really boost your cash flow and make sure that you have a stable cash flow stream that you can retire on and count on long term. So I hope this helped. If you guys like this content, please feel free to follow, and you can visit us at MathewOwens.com with 1T in Matthew if you guys want to learn more. Look forward to talking with you soon.